The closing bell rang 15 minutes ago, and the scoreboard is completely brutal. We're looking at the S&P 500 down 0.4% to 7,553.68. The Nasdaq dropped 0.89% to 26,853.98. And the Dow took the absolute heaviest hit today, shedding over 620 points.
Yeah, that's a 1.21% drop into the close. The Russell 2000 took it on the chin, too, down 1.3% to 2,893.50.
Right. So we are doing a deep dive into the closing print and the institutional order flow right now because that historic 9-day winning streak just slammed into a brick wall. And look, the surface narrative on the floor right now is all about the Middle East headlines. But the actionable data, the real story of this reversal, is buried in the plumbing.
Exactly. I mean, the catalyst definitely originated overseas, but it was really just the match that lit a powder keg of, massively overextended valuations. Over the last 24 hours, we had a severe escalation in the Middle East, drone and missile strikes hitting infrastructure in Kuwait and Bahrain.
Which completely shakes that recent ceasefire.
Right, and that was immediately followed by a U.S. retaliatory strike on an Iranian military outpost right in the Strait of Hormuz.
So global capital reacts instantly, right? It just floods into the commodity markets. We saw Brent crude spike nearly 2% to hit $97.81 a barrel. And WTI was pulled right up with it to $96.48.
And when energy costs spike that violently, you get an immediate shockwave straight into the bond market because expensive oil is a direct transmission mechanism for inflation.
The bond market priced in that inflationary threat in minutes. It dragged the 10-year Treasury yield up to a punishing 4.49%.
Which is just toxic. When you're managing institutional tech portfolios, that risk-free rate acts like gravity on your valuation models. Growth stocks rely on discounted future earnings, and when that discount rate surges to 4.5%, the multiples you're willing to pay for forward-looking tech earnings they collapse.
But the real risk here is misinterpreting the tape. You have this 9-day melt-up built on multiple expansion running headfirst into a geopolitical shock. But if you look at the volume data from the closing print, there wasn't actually a massive panic.
No, not at all. Which is wild when you think about it.
Right. I mean, NYSE volume actually closed 3% below its one-month average. The Nasdaq finished 5% below its average. So if the macro backdrop was deteriorating that fast, why wasn't there a rush for the exits?
Because the buyers simply vanished. A market drops when sellers overwhelm buyers, sure, but it goes into an absolute freefall when the bid side of the book is completely withdrawn. Institutions weren't indiscriminately dumping their core holdings today.
They just paused their algorithmic accumulation program.
Exactly. They stepped away from their desks. When you have hawkish macro data layering on top of geopolitical risk, you do not step in front of the freight train to catch a falling knife. You let the market undergo this low liquidity drift until the selling just exhausts itself.
And we had the ADP private payrolls report dropping into that exact same environment this morning. The data came in hotter than expected, 122,000 jobs against a consensus of 110,000.
Which forces the market to price in an economy that is still running way too hot for the Fed's liking. So the prospect of any rate cuts gets pushed further out.
So you have this ultimate toxic cocktail for equities, right? Hawkish labor data, surging oil, and rising yields. But we really need to look at how fragile the underlying market structure was before any of this news even broke. It's like a Jenga tower.
Oh, totally.
Where all the bottom pieces have been pulled out just to build this incredibly heavy top. When a wave finally hit the hull today, the whole ship capsized. Not because the wave was this unprecedented tsunami, but because the structure was fatally compromised to begin with.
Yeah, the internal breadth data from Stifel illustrates that imbalance perfectly. Going into today's session, the top 10 stocks controlled nearly half of the S&P 500's total market value. Half.
That is a 40-year extreme in concentration?
Right. And since the indices are market cap weighted, the broader market's performance over the last 9 days was essentially a mirage. It was just masking incredibly narrow leadership.
Which means when the mega caps stumble, there's absolutely zero safety net. We saw Nvidia and Microsoft both drop over 3% today, and by midday, the internal breadth was completely fractured. We had 242 advancers against 262 decliners.
And that's exactly why the Russell 2000 took the heaviest beating. Small caps are incredibly sensitive to debt refinancing costs. So when that 10-year yield jumps to 4.49%, capital just abandons companies that don't have massive balance sheets.
So the risk-off rotation was aggressively defensive today.
Very. I mean, while the technology and communication sectors fell 1.4%, the energy sector actually advanced 1.4% as institutional capital chased that commodity spike.
Okay, but I want to challenge that narrative of a passive, quiet volume drift for a second. You say institutions just stepped out of the way, but look at the tape on new holdings today, ticker NU. Over 106.4 million shares were liquidated.
Yeah, that was brutal.
That is 98% above its average volume. It slid all the way to $11.65. That doesn't look like a passive buyer strike. That looks like an aggressive, coordinated exit.
Well, you have to separate macro index flows from idiosyncratic stock risk. The broader market drifted lower on a lack of bids, sure, but specific equities were violently re-rated based on localized catalysts. News holdings suffered a massive institutional liquidation because of a cascading downgrade cycle.
Right, Bank of America cut them yesterday after that sudden CFO departure.
Exactly. And then Susquehanna piled on this morning, slashing their target from $18 down to $13. When you have structural management shifts combined with a deteriorating macro environment, funds don't just drift out, they execute high-conviction exits.
And we saw that similar high-conviction rotation in the mega-cap space, too. Alphabet slid to $358.68 today. And this is after increasing its massive AI infrastructure equity raise to $84.75 billion.
Which is just a staggering amount of capital.
It is. Even with Greg Abel over at Berkshire Hathaway anchoring a $10 billion private placement for them, the broader market completely punished the stock.
Because an $84 billion equity raise is a massive supply shock to the float. It instantly sparks dilution fears. I mean, you're printing more shares to finance AI servers, which mechanically reduces the ownership percentage of existing shareholders.
But wouldn't the market usually buy that AI growth narrative?
In a zero interest rate environment, maybe. But when risk-free yields are at 4.5%, investors demand immediate capital efficiency. They are not going to absorb historic levels of dilution for infrastructure that, might not pay off for half a decade.
Which leads right into what happened with Palo Alto Networks, PANW. They reported Q3 earnings last night, absolutely smashed their estimates, and have raised their full-year guidance.
Yeah, a flawless beat on paper.
Right. Analysts bumped their price targets this morning, yet the stock bled out all day, tumbling 5.83% to close at $279.84, nearly 6% of its market cap wiped out in hours on a flawless beat.
It was a textbook sell-the-news liquidation. Late in a cycle, top-line beats are just no longer sufficient to sustain a premium multiple. The institutional focus shifted entirely to the underlying mechanics of their software margins.
So any ambiguity in forward margins triggers a fade.
Precisely. There are widespread fears over margin compression in the cybersecurity space right now. When the market is actively looking for an excuse to de-risk, they'll use anything.
And we saw that exact same vertical fatigue in Marvell Technology, MRVL. Nvidia's CEO Jensen Huang name-dropped them yesterday as a massive AI chip play, sending the stock up 32%.
The FOMO was real on that one.
It opened at an intraday peak of $336.96 as retail traders rushed in. But institutions used that retail liquidity as exit liquidity. They aggressively locked in profits and faded the stock down to $307.49 into the close.
Because there was absolutely zero buy-the-close activity today across the board. The algorithms that typically sweep the closing bell for momentum plays, they were turned off. Active portfolio managers are stepping into a heavily defensive posture.
Let's shift to the mechanics of fear in the options market. Because the VIX closed up 1.78% to 16.05. Now, a 16 print is hardly signaling a generational panic.
It's not a panic, no. But it is a regime shift. The artificially suppressed implied volatility that fueled the leverage behind that 9-day melt-up is officially drying up. A VIX at 16 shows that options desks are repricing tail risk. They're widening their spreads and buying protection against further geopolitical deterioration.
And that leads us to the most critical technical breakdown of the session. The S&P 500 sliced straight through the gamma flip level at 7,575 today. For the listener who maybe isn't deep in the weeds of options market plumbing, walk through the actual mechanics of what happens to dealer flows when we cross that threshold.
Okay, so options market makers operate like the house in the casino. They don't take directional bets on where the S&P is going. They profit off the spread and the premium. To maintain a neutral book, they constantly gelt a hedge.
Meaning they buy and sell the underlying equities depending on where the index is moving.
Right. When the market is above 7,575, they're in a positive gamma environment. Their hedging actually stabilizes the market. They buy the dips and sell the rips to stay neutral.
But dropping below 7,575 flips that entire stabilizing mechanism upside down.
Exactly. We closed below the gamma flip, which means dealers are now operating in a negative gamma regime. Their risk models dictate that as the market drops, they must sell into that weakness to protect their books. If the market rises, they have to buy.
So instead of dampening volatility, they are mathematically forced to amplify it.
It's a structural feedback loop. The further it drops, the more they have to short, which pushes the price down even further.
The strategy briefings flag 7,550 on the S&P as the acceleration trigger for tomorrow. If we cross below that early on, dealer-driven selling will cascade rapidly. So where is the structural floor to actually halt that slide?
The major put wall currently sits at 7,500. That is the absolute floor. It's the strike price with the heaviest concentration of institutional put options. When the index approaches that level, the monetization of those puts typically acts as a heavy trampoline. It provides enough underlying buying pressure to bounce the market or at least, halt the free fall.
Okay, so factoring in the negative gamma, the geopolitical risk, and the bond yields, what are the actual statistical probabilities for Thursday's session?
The quantitative models in the briefings assign a 30% probability of a gap and go down setup, meaning an immediate continuation of today's heavy selling. However, they assign a 70% probability to an inside consolidation or a mean reversion day.
Wait, why is the probability of a bounce so much higher when the market plumbing is actively working against us?
Because institutional trend days naturally exhaust intraday momentum. Short sellers who made a killing riding the momentum down today, they'll look to buy back their positions and lock in profits shortly after the open tomorrow. Market makers will reset their books overnight.
So you don't just blindly chase a gap down at the open.
Never. The smart money is playing the tech-to-energy rotation, going long on crude pullbacks and aggressively shorting any low-volume tech bounces until those bond yields finally cool off.
And speaking of tech, we have two massive day two plays for tomorrow based on after-hours earnings from the AI sector. Let's start with Broadcom, AVGO. They reported non-GAAP EPS of $2.44, beating estimates. Their AI semiconductor revenue was up 143% year over year.
Massive numbers.
Yeah. They even guided next quarter's AI chip revenue up over 200% to $16 billion. On paper, that is a flawless execution of the AI narrative.
Yeah.
Yet the stock plunged over 6% in the after-hour session.
Because in a market priced for absolute perfection, anything less is severely punished. Broadcom had a minuscule miss on total gross revenue. They reported $22.187 billion against a $22.27 billion consensus.
And that slight top-line fracture was all the algorithmic trading models needed to execute a sell program.
Yep.
So what is the strategy for a stock that dropped 6% on an otherwise stellar AI growth report?
Institutional desks are eyeing a washout and reclaim setup. If Broadcom opens heavily in the red tomorrow, you do not short the whole. You wait to see if the buyers step in to reclaim the opening 15-minute highs. If it reclaims that level, the dip is bought.
Because the secular growth narrative for their custom AI silicon is completely intact.
Exactly, making this a prime candidate for a volatility shakeout rather than a structural top.
The second play is CrowdStrike, CRWD. They announced a 4-for-1 stock split and beat on both EPS and revenue. But the stock was completely decimated in after-hours trading. It fell nearly 9% to around $681.95.
And the trigger there was a miss on billings. Billings grew 17.7%, missing Wall Street's target.
Explain why billings are the absolute lifeblood for a software-as-a-service valuation.
Because revenue is a backward-looking metric. It tells you what you've already recognized. Billings are forward-looking. They represent the actual invoices sent to customers for future contracted services. A miss on billings indicates that the future sales pipeline is actively decelerating.
And when you can lock in a 4.5% risk-free return on a Treasury bond, nobody's going to pay a massive growth premium for a software company whose future cash flow is already showing cracks.
Exactly. High-yield environments are notoriously ruthless to SaaS companies. The institutional plan for CrowdStrike tomorrow is trend continuation. If the stock fails to reclaim its after-hours support levels right out of the gate, traders will look to aggressively short the breakdown.
So the core lesson from today's deep dive is that the record highs we saw just 24 hours ago were built on incredibly fragile foundations. The relative strength index on the major averages was sitting well over 70, meaning the momentum engine was completely tapped out.
We had historic concentration at the top, and options dealers were positioned right on the edge of a gamma flip. The market was a coiled spring of anxiety. The Middle East headlines were just the excuse the algorithms needed to initiate the rotation.
Control of the tape has definitively shifted away from passive accumulation and directly into the hands of macroeconomic defense. But that leaves you with one final, totally fascinating divergence to consider before the opening bell tomorrow. While the entire financial world was agonizing over multi-billion-dollar AI server raises, Middle Eastern crude oil, and software billings, there was one wild trade today that flew completely under the radar.
Oh, the agricultural commodities.
Lean hog futures. After hitting 6-month lows in early morning trading on-demand fears, lean hogs pulled off a textbook, massive bullish key reversal in the afternoon session.
Yeah, driven by massive short covering and a $2.50 surge in real-world pork cutout values.
Which is amazing. In a top-heavy, highly anxious market dominated by negative gamma algorithms and overextended tech multiples, there is still real, tangible value to be found in something as simple as pork.
When an $84 billion AI equity raise gets punished but pork cutout surge, it really forces you to reevaluate what the market actually considers a safe haven in a rising rate environment.
It is the ultimate reality check. Review your risk parameters tonight. Do not blindly chase the opening gaps, and pay close attention to that 7,550 level on the S&P tomorrow. Keep your wrists tight, stay curious, and we will catch you on the next deep dive.